Hi everyone, today I am going to take the class on the Accounting Standard 10, which is accounting for property, plant and equipment. As we know that Accounting Standard 10 means it gives a guidelines on how to record, value and show fixed asset in the financial statement of a company. There are four major principles in Accounting Standard 10 and they are recognition, initial cost, subsequent cost, depreciation and disposal. So coming to the recognition, it means deciding when and whether to record an item as an asset in the book of accounts. So moving to the initial cost, it means the total amount of money a company needs to buy an asset and make it ready for use. Third one is subsequent cost. It means any money spent on the asset after it has been purchased or put to use. Moving to the fourth one, depreciation and disposal. It means depreciation means gradual decrease in the value of the asset because of the use, wear and tear and all. And disposal means selling, discarding or removing an asset that a company had no longer use. So here the PPA represents a company's tangible long-term investment. So there are two conditions for PPA recognition, and the first one is probable future economic benefit. That means an item should be expected to generate a revenue which reduce the cost or otherwise contribute positively to the enterprise future operations. So the second condition is cost measured reliably. It means the expenditure must be quantifiable and verifiable. You must have your documents like invoices, contracts or agreement that prove the cost of the item. Also, there's a look where low value items meant for immediate resale like inventory around, which will not be classified as PPA even if the cost is reliable. So next is initial cost, that is capitalizing all necessary expenditures. So the initial cost of PPA goes beyond the striker price. Striker price means purchase price. So it includes all the expenditure required to bring the asset to the location and condition necessary for it. So there are purchase price, non-refundable tax and duties, transportation and handling costs, installation, assembly and testing costs, professional fees and directly attributable overheads. So next is subsequent expenditure, that is repair versus capital improvements. Expenditure after the asset is in use or assets based on the impact of the economic future benefit. So the distinction determines whether the cost is capitalized or expense. So capitalized means there is an improvement in the asset where the extend asset useful life, and the second point is it increase the asset operating capacity, and third one, it significantly improve the product quality or its efficiency. Also it add the asset original carrying amount and its depreciation over the remaining life. And the second is expense, that is maintenance. It means the asset as its current and original standard, and it routine service, minor repair and general gear-up and all. It does not increase the future economic benefit, and it charges the income statement immediately when incurred.
Next, we are going to discuss about depreciation. There are two types of depreciation methods. First is straight line method and second is reducing balance method. First is straight line method. It is a simple accounting technique that spread the cost of an asset equally over the useful life. The formula for straight line method is assets minus average value of useful life, and the second one is reducing balance method. It is a method of calculating depreciation by applying a fixed percentage to the asset's book value each year. Next is components of depreciation. There are three components, that is cost. First one is cost, second one is residual value, third one is useful life. Cost means the initial capitalized amount of an asset, and second one is residual value, the estimated amount of the company expected to obtain from the disposal of the assets at the end of its useful life, and third one is useful life, the period over which the asset is expected to be available for use or the number of production units expected to obtain. This is known as these are the three components of depreciation. Derecognition. Derecognition means when an asset is removed, when an asset or liabilities is removed from the company's financial statement. Here is the calculation of gain or loss. The difference between the net proceeds from disposal and the assets carrying amount, that is the cost minus accumulated depreciation is recognized in the income statement. Here is an example. A machine is solved by 2 lakh. It means there is a 50,000 gain is arising from this example. So that is meant by re-repetition. Next is key takeaways and practical cautions. First one is record reliability, second is review estimates, and third is control classification. Record reliability means maintain reliable records, original invoices and contracts to justify every calculated cost and accurately calculate depreciation. And the second one is review estimates. Set the realistic useful lives and residual values and perform the required annual reviews to apply prospective adjustments. And third one is control classification. Implement clear accounting procedures to correctly separate capital improvements. So these are the three key takeaways and practical questions to be followed under next step. Thank you.
So here we are going for a case study based on accounting standard 10. So Amna Limited acquired a machinery for rupees 50 lakh, by cost rupees 1 lakh, professional fees paid is rupees 2 lakh. General overhead inquired during the installation period are rupees 5 lakh. The entity spent rupees 3 lakh to remove the existing machine and to prepare a proper base for the new machine in addition to the above expenditure. It is spent rupees 2 lakhs for the trial run material and labor. The product manufactured during the trial run are sold for rupees 25,000. So what is the cost of acquisition of machinery as per accounting standard 10? So here is the solution for the case study. Here the first we want to add the purchase price, which is 50 lakh, and next is the price cost, that is 1 lakh, and the professional fees 2 lakh. Then site preparation cost, it comes 3 lakh, and the trial run cost, which we have reduced 25,000 from 2 lakh, that is 1,75,000. So the final answer of the cost of acquisition of PP is 57,75,000.
Hello friends, today we are going to study accounting standard 16, borrowing cost with real examples. Introduction to borrowing cost, definition. Borrowing costs are interest and other costs incurred by an enterprise in connection with borrowing of funds. Objectives to describe the accounting treatment for borrowing cost. Examples: interest expense on short-term and long-term borrowings. Amortization of discount or premium on borrowings. Finance charge on lease liabilities. Scope of AS16. It is applicable to all borrowing funds for long-term and short-term projects, and it is not applicable to the borrowing cost directly related to inventories produced in large quantity on the repetitive basis, and it is focused on when and how borrowing costs should be capitalized as a part of cost of a qualified asset. The key terms of AS16. First one is qualified assets, an asset that necessarily takes a sustainable period of time to get ready for its intended use or sale. And second one is capitalization, including borrowing cost as a part of cost of qualified assets. And third one, period of capitalization, begins when borrowing cost and expenditure starts and ends when asset is ready for use. Example: construction of a plant or factory, and second, large scale real estate project.
So let's discuss about the recognition and treatment. So there are certain costs to be borrowing costs to be capitalized and borrowing costs to be expensed. Coming to the capitalized, it is directly attributable to the acquisition or construction of a qualifying asset. And coming to the borrowing costs to be expensed, all other borrowing costs that do not qualify for capitalization. And the formula for general borrowings is capitalized amount is equal to average expenditure multiplied to weighted average borrowing rate.
The importance of accounting standard 16 in corporate accounting. The first one is consistency and transparency. Ensures consistency and transparency in financial statements. The second one is accurate asset valuation. Provides accurate asset valuation by capitalizing relevant borrowing costs. The third one is prevents misleading profit figures during construction or development phases. Useful for investors evaluating long-term projects, auditors and regulators for ensuring compliance. Challenges and practical considerations. The first one is timing of capitalization. Determining when to start and stop capitalization. The second one is documentation. Maintaining documentation and audit trail. The third one is multiple finance sources. Handling multiple sources of finance with varying interest rates. The fourth one is disclosure requirements. Ensuring disclosure of capitalized versus expense borrowing costs. Conclusion. As accounting standard system guides how borrowing costs are recognized and presented, capitalization ensures fair asset valuation for long-term projects. Real-life applications like Tata Power Reliance show its significance in corporate accounting. Key takeaway: correct treatment of borrowing costs enhances transparency and predictability in financial reporting.
Let's discuss a question regarding the accounting standard 16, which is borrowing cost. A company is constructing a new corporate office building. The construction began on 1st April 2024 and is expected to take 18 months. The company had the general borrowings account. The whole thing mentioned here is the loan accounts. Loan A, which is of 1.5 crores of 9% interest. Loan B, 2 crores of 11% interest. Loan C, 1 crore of 13% interest. During the year ended 31 March 2025, the company spent rupees 2 crores from this general borrowings on the construction of the office building. So we have to find out the amount. So coming to the answer, here the office building is taking 18 months to complete. So for any asset to become a qualifying asset, it has to be at least more than 12 months. So here it is 18 months. So it is a qualifying asset as per accounting standard 16. So next is to calculate the weighted average. The formula for calculating weighted average is summation of interest rate divided by sum of borrowed cost into rupees of borrowing. Here, as I mentioned earlier, there are 3 loan accounts: 1.5, 2 crores and 1 crore. We have to sum this amount with the corresponding interest rate. 9% of 1.5 crores plus 11% of 2 crores plus 13% of 1 crore, whole divided by the sum of loan amounts, which is 4.5 crores, whole multiplied by 2 crores. And coming to the answer, we will get 48,50,000 divided by 45 lakhs into 2 crores. The answer will be 10.7% interest, and it has to be multiplied with the 2 crores, and the final answer is 21.4 crores. Hope you guys understand.